How did pegged exchange rates lead to the 1997 Asian financial crisis? Imagine a country trying to keep its currency value steady by tying it directly to the US dollar. This is what pegged exchange rates are all about. Countries in Asia did this to attract foreign investors and keep inflation low. It seemed like a good idea at first, but it set the stage for big trouble down the line. When a country's currency is pegged to the dollar, it means the government promises to buy or sell its currency at a fixed rate. This sounds stable, but it also means the country can't let its currency weaken or strengthen naturally. If the economy starts to weaken or the dollar gets stronger, the pegged currency moves in tandem, even if that's not good for the country's exports. During the mid-1990s, the US dollar was often strong. When this happened, the Asian currencies that were pegged to the dollar appreciated in real terms. This made their exports more expensive and less competitive worldwide. Countries like Thailand, Indonesia, and South Korea saw their exports slow down, which hurt their economies. At the same time, the fixed rate encouraged investors to pour in money because they saw little risk of currency loss. They bought lots of short-term foreign currency loans and invested heavily in local assets. Banks and companies borrowed in dollars, assuming the peg would keep their currency stable. But this created a big problem. When economic conditions started to worsen, such as rising debts and deficits, investors grew nervous. They began to doubt whether the pegs could hold. Rumors of possible devaluations caused a rush to withdraw money. Investors sold off their holdings, causing a flood of capital outflows. Countries like Thailand tried to defend their pegs by using their foreign reserves, but these reserves quickly ran out. Thailand was the first to give in. On July 2, 1997, they let the baht float freely. The baht's value plummeted, and this triggered a domino effect. Other countries with similar pegged systems faced the same fate. Their currencies devalued sharply, and their economies went into severe recessions. The crisis exposed how pegged exchange rates can hide underlying economic weaknesses. When the pegs broke, the true vulnerabilities appeared. Countries faced collapsing asset prices, banking crises, and deep recessions. The crisis showed that fixed exchange rates can be risky, especially when combined with high external debt and rapid capital flows. In short, pegged exchange rates created a false sense of security. They encouraged risky borrowing and investment, which worked fine until the dollar's value changed or economic fundamentals weakened. Once confidence was lost, the system collapsed, leading to the major economic disruptions of the 1997 Asian financial crisis.